Let's see if you can come up with the correct answer. I'll warn you in advance, it's pretty easy, but here you go. In a lake, there's a patch of lily pads. Every day, the lily pad patch doubles in size. If it takes 48 days for the patch to cover the entire lake, how long will it take to cover half of the lake? While I give you a minute to think about that answer, I'm sure you're wondering why I started with a question like that. Because questions like these have the ability to determine your investment success, because they help you identify your biggest enemy when it comes to investing. How about I give you that answer before I continue? The answer is 47 days. Yep, about 75% of you guessed 24 days. And about half of you that guessed 24 days are downright upset and ready to argue with me that the answer is 24. No matter how mad you get, the answer is still 47 days. And I'll explain that in a few minutes, because right now, the answer exposed your tendency to go with your impulse answer over your logical brain, which ultimately highlights one of the ways in which you can be your own worst enemy when it comes to investing. More of that in a moment. Like I expected, I received some what I'll call interesting responses to my previous video, and while I wasn't shocked, I'm still amazed by people and human behavior. As someone who believes in behavioral finance, I really shouldn't be surprised, because fundamentally, behavioral finance challenges the traditional assumption that people are always rational and that financial markets always find efficient ways of resolving itself. It acknowledges that human behavior can be irrational and emotional, leading to suboptimal financial decisions. That is exactly why, regardless of the nonsense people talk, most people end up buying high and selling low. And in more times than not, they take what investors call the round trips with their investment. They buy it, watch it go up, never take profits, then ride the investment back down just to sell low. Or they take the ride all over again, like an endless ride on a roller coaster. Well, it doesn't take many times around on that roller coaster before you start regretting your life decisions, and the same thing is true when it comes to investing. It's fascinating to see how people reacted to this idea of platinum being a better investment than silver. Mind you, I specifically use the same logic and rationale used to justify that silver is a better investment than gold based on historical ratios. No one had an issue with that. You'll hear silver bugs constantly talk about silver being a great investment based on it being at half of the all-time high. They will also point to the gold to silver ratio to support their position. My argument was simple. Using that same logic, platinum checks all the same boxes, and historically, based on the platinum to silver ratio, platinum is cheaper than silver and should outperform. Oh Lord, you would have thought I had slapped their mother, kissed their wife, and took their dog the way some folks reacted. My goal of that video was to make the case that there may be a money-making opportunity we might be missing because of a blind spot. It's these blind spots and these biases that often lead to suboptimal investment decisions. I'm going through all this because the whole ordeal really highlights some of the biases that behavioral finance highlights as barriers to successful investing. And I want to present some of these to you in hopes of you being more aware so you don't fall victim to them. Because you as the investor is always the riskiest part of the investment. And some of you have seen this clip before, but hopefully my Uncle Rick rule can convince you.
I think the biggest risk to consumers is conveniently located to the left of their right ear and to the right of their left ear.
For example, going back to the lily pad and the lake question, if the lily pads double every day, then we all would agree that once the pads cover half of the lake, it would double and cover the whole lake the very next day. So let's work backwards. Day 48 results in the whole lake being covered. So that means the day before day 47 was when the lake was covered halfway. See, most of us just jump to 24 because it's the fastest and easiest answer. And some of you remember me covering this before in a video around our X system and our logic system. And in a nutshell, our X system is based on our emotions, and it uses mental shortcuts like similarity, familiarity, and proximity and time to help us come up with quick answers. Some might even call it trusting our instincts or your knee-jerk response. But fast doesn't always mean correct or accurate. Meanwhile, your logic system is slower but tends to be more accurate. The more we rely on our X system, the more likely we are to fall victim to these behavioral biases and tenets that can impact our investing. I call these the 4 deadly sins of investing in gold and silver. Let's start with one of the most dangerous ones in my opinion, which is herding behavior. This is where people often follow the crowd and make the same investment decisions as others, even if those decisions aren't based on sound analysis. I find this to be the most dangerous because it really is about seeking comfort and being in the crowd. And when it comes to investing, if you're investing with the crowd, you're likely too late to make any significant gain. In investing, your money is made when you invest in things that are out of favor. As Warren Buffett says, you buy straw hats in the winter. As holders of physical metals, we're simply waiting for the rest of the world to catch up with us and realize that gold and silver are real money and what they should be holding. I will also tell you, about time Joe Public starts really piling into metals is the time you want to start taking profits and considering the next investment opportunity. Remember the anatomy of a bubble chart here? I've shown this to you a billion times, but this is what happens. This is a cycle. And so if we know people are going to run it at the end, that allows us to make better decisions. The other danger associated with this behavior is you tend to develop groupthink, right or wrong, and I see this all the time on message boards and group discussion platforms. And as a result, when confronted with opposing ideas, people tend to recoil and lash out against anything that doesn't fit their narrative. That is why we explore all aspects of the economy and metals markets on this channel, because things can change on a dime, and we always need to be looking for either confirmation or a confluence of variables happening at the same time to let us know or to confirm that we're on the right path. Number 2, related to this, is called the endowment effect, which is where people often place more value on things they own than on the identical things they don't own. I witnessed this recently when people really railed against this idea that platinum was a viable, undervalued investment, especially in comparison to silver. But I've also seen this related in other ways where I did videos early on about mining stocks and people were not interested. Here's what didn't make sense to me. If we believe in metals and we believe metals are going to the moon and they're going to do multiples, why in the world would you not put some money in the companies that find the metals and bring those metals to market? Why would we miss an opportunity for leveraged growth of our money? Miners could go 5 or 10 times X the amount of money that you invest in them. Of course, there's risk, but there's risk in crossing the street and driving a car. But most of us do that every day because we don't run from risk. We manage risk, not avoid it. Number 3, and I want to talk about, is anchoring, because this is when people tend to rely too heavily on the first piece of information they receive when making a decision, even if that information is irrelevant or inaccurate. As an investor, you have to constantly be challenging your investment thesis. In fact, in the research world, we often prove our theory by disproving the null or the opposite theory. You have to learn to seek information that confirms your belief by disproving other possibilities sometimes, because the danger is the next, which is number 4, confirmation bias. This is problematic because this is where people only seek out information that confirms their pre-existing beliefs, and they ignore all the information that contradicts their belief. This is how people end up in echo chambers where they only hear the same information over and over again. Just look at your YouTube homepage and look at the videos that you see there and see what gets the most views. I'm sure it's something that has to do with the death of the dollar, economic collapse, China or Russia on the cover, or some ridiculous number about gold and that it's going to go to, which ultimately creates this loop where you end up with the herd all over again. Over the years, I have learned that I don't want to be with the herd or the lemmings. It's not our fault that we aren't taught the principles of investing or sound money management. Instead, we're taught to consume. While it's not our fault, it is our responsibility to be the best investor you can, as you truly are the greatest risk to your investments. My hope is that you remember these 4 concepts or tenets of behavioral finance as you continue on your investment journey, as these behaviors can have a profoundly negative impact on you and your investment, making you, as we say in the church, frustrated, disillusioned, and hard to get along with. In the comments section, have you fallen victim to any of these behaviors? If so, which one? What are some of the ways that you can combat or avoid these potential investment pitfalls? Don't forget to put an A+ in the grade book so everyone can know what kind of student you are, because around here at Stackers University, we always stack smarter and never stop learning.